In this video, I'm going to teach you ICT's advanced market structure. I'm going to go deeper into how to find the real order blocks called ITOBs and how to implement them into your trading with a better understanding of how price action actually works than ever before. So if you're getting stopped out a lot, if you don't know which market structure shift you should actually take, this video is going to change your trading. So does that sound good, you guys? You guys ready to learn? Let's jump into it. So I don't charge for this information, but what I do need you to do is hit the like and subscribe button and share it for me, guys. That will really help my channel out. So in this first section of the video, I go over short-term highs and lows, intermediate-term highs and lows, long-term highs and lows. My understanding is a lot better now. All right, so here we are on NQ, and I'm going to be breaking down the advanced market structure as taught by ICT. So this will help with your problems with getting stopped out a lot and not knowing when to enter positions, and it's also going to help you identify the best smart money concept entries and exits. So let's go ahead and get into it. So there's short-term high examples of what I'm showing you right now. So a short-term high is a failure swing. So I have an example here. As price comes up, probably run stops over there, and then this that comes up and it fails to go above the high to the left there. So then you would mark that off as a short-term high. You'll see them everywhere, pretty much like this is a short-term high, that's a short-term high, like they're failure swings. Anytime a high is put in, this is something you will see almost every single time. It goes back down, comes back up, and this is going to give you a really great entry. You see it almost every reversal is going to have a short-term high being put in, and then it will continue down. All right, example of intermediate term high. So there's two definitions that give. The only one that I really use is the one that fills the imbalance, but I'm going to break them down both for you so you can use it how you like. So let's start with the first one, the one that fills an imbalance. It can fill a fair value gap, volume imbalance, or a liquidity void. So as you can see, it came up here, filled in the fair value gap. So that automatically makes this high, this swing high that put in place here, a intermediate term high. So the second definition is it has a short-term high to the left and right. So that's why I taught you guys short-term highs first. So you have a failure swing here, then it comes up, fills an imbalance, drops back down, and then here is the failure swing. So this is where the ITOB that I taught in the last video would be. It would be here in a lower time frame. So the short-term highs do not have to be lower than the ITH. I know that's confusing, but that's the way ICT teaches it. But like I said, I don't use it that way. I just straight up use it. I'm only focusing on one that filled in imbalances, and I think that provides the easiest definition and the best example for you guys. So all right, now let's go on to long-term highs. All right, so here we have an example of a long-term high. So in that original YouTube video I did, the market structure one, my understanding was lacking, and I didn't quite understand the long-term highs and how to find them. So now I do. So let me break that down for you. So a long-term high does not have to be on the higher time frame. Has an ITH to the left and right of it. So you see how like you have a short term, intermediate term, and then long term. The intermediate term also has short term highs to the left and right of it, but the long term has intermediate term highs to the left and right of it. So here's an example. Let me break it down for you. So it comes up, there's a fair value gap here, comes up, closes with inside the fair value gap, so it's still a valid fair value gap because no close above it. comes down, comes in, touches the volume imbalance, the daily volume imbalance. This is a 4-hour chart. And then also is filling in this fair value gap. Notice the closes do not disrespect the fair value gap. And then it comes down, and then another intermediate term high forms. So this is a long-term high. So you can find them on the same time frame you're doing. It just needs to have an intermediate term high to the left and right. And then you could classify the intermediate term highs as having a short-term high to the left and right of it, or you could just use it like I do. So how is this going to help you in your trading? So for one, the ITOB that I went over in my prior video, that's number one. And then number two is stop placements. So if the market's going to continue in a bearish direction, the intermediate term highs should hold. They should not be violated. And when they are violated, that's going to tell you that there's a change in character, like a legit change in character, not a break of structure, but a legit change of character, because now the fair value gap's being violated. That's one. And then two, the intermediate term high is being violated. And then it's usually a leading sign of what's to come. All right, so before we get back into the content in my video that's going to change your trading for good, let me show you my website. It's verifiedfundingcompanies.com. Once you get to the page, click up here. It's going to take you to the latest discounts of the companies that I know are legit, because I'm either funded with them or have been and receive payouts. So there's Blue Knox has an 80% off sale, and so does Apex. And there's other good companies on here as well, but I recommend these two the most. Any the discounts you like, you can either click on the picture or a little box there. So I will put the link in the description to my website and all of my socials. Guys, check them out. Let's get back into the content. So, all right, we are in an uptrend here, right? It's respecting. These are being respected. So you have a fair value gap there, respected, and then respected. See how they continue to be respected as price keeps moving up. Respected. And then this is when it starts to get a little disrespect going on here, right? So right here, that right there, it just disrespected an intermediate term low. So people probably were still thinking we're going to continue up higher, but you, after learning this, are going to know that we're now bearish. It doesn't get much simpler than this. You look for the intermediate term lows and highs and see which side of the market is respecting them and which side is disrespecting them. So it came down, it disrespected it, bearish now. Yes, it might come back up here and do whatever it's got to do, consolidate for a little bit, but you shouldn't be expecting the highest high up here to be broken or anything like that. If you look here, after that, not one of these highs that put in got broken. Not one of them. So it's going down. And then now we can do it on this side of the market. Let me delete this. Okay. And then now that we're going lower, we want to see ones that are filling in balances to the top, putting in intermediate term highs, are now being respected. So goes down, respected, and then respected, right? Are you guys starting to see what I'm talking about here? And then we have a break of intermediate term highs here. I hope that helps you guys understand how to use the market structure to not only for the best entries for the intermediate term order blocks, but also fair value gap, continuation, stop placement. Like it's almost like the best thing you can use because you're not having to use an indicator. You can see it almost immediately, and it's a forecasting tool, entries, and all of that. So in this next section, I covered the intermediate term order block, how to identify applying multiple time frames and using it for stop placement. Yeah, so I'm going to walk you guys through how to find the ITOBs. So you're going to look for a fair value gap, and then we're going to mark it up. That's step one. Find a fair value gap, mark it up. And there's one right here. So now you want to see a retracement into the fair value gap. Step two, that's it. So now you have identified an intermediate term low. Right there, that's an intermediate term low. So the last down close candle right there. See that? It can be several candles that can be in this fair value gap. You pick the last down close candle before more expansion up. So let's go to mark that off orange. Voila. So there you have it. Goes into there, hits the ITOB perfectly. And then you can even go, let's use this as another example here. So here we have a fair value gap. Where is the last down close candle in here? It's right here. So go ahead and mark that off like that. And this works really well because it's using two different things. It's using advanced market structure, and then it's using down close candles that will support upward price movement. And you could even use the wick at the doji here because it's not an up close candle, it is technically a down close candle. And then you get exactly to the tick. Like you see that? Like it's so precise. It dips right into the tick there. Down. Let's go back a couple days here. Let's just pick a random day at the New York Open. Let's pick the 16th. And for this, I'm just using a 15-minute time frame, but that's not the time frame I traded on, but it just has clear candles that show price very well. Easy to find examples with. So we need a consistent downtrend here, which the market's been going up. So here's one. It's not very pretty, but it will work for the example. So you have a fair value gap here. And then also one here as well. All right, so it's red. Boom. Boom. All right, so price goes up, it's filling it, so that makes it ITH. Just to note that this is also an ITH, so just use this as an example. This is invalid because this is already, it's been broken. The ITH here has been broken, so price is likely to go up, as you can see. So here you're seeing the disrespect and respect of the intermediate term high, showing that price is likely to go up at some point. Like the tide is turning here. So now that we have our ITH here, last up close candle is the ITOB, which will be right there. And you get a dip into it and the rejection. And on a 15-minute time frame, this is 50 points. So I mean 50 times 50, you do the math. All right, so now we're going to go into how to apply multiple time frames to trade the intermediate term order blocks. So right here we have price dipping down into a fair value gap on the 20th. Let me just go and turn the indicator off. So as price dips down, where is the last down close candle that filled the fair value gap? Let's mark up the fair value gap real quick. So it's right there, right? So let's mark this up orange. Voila. So this is how I would do it. I would then drop down on a lower time frame and catch this. But see how the candles closes are respecting the ITOB, right? Same thing with the fair value gaps. The candles must respect it. You can wick through it, but they can't close through it. So now let's go ahead and drop down to a 3-minute chart. I would trade it. And then you're going to use it as a point of entry. So let's find the actual fair value gap where it started. So you can see price came down into here, build it. So then this is the fair value gap on the 4-hour. And then this is the ITOB. And then now that you have a point of interest, this is from this Friday, the 24th. So price came down into the ITOB. And then this is that midnight opening trade that I've named the slip and rip. You have the midnight opening here. You have equal highs there. And then, so 8:30 I entered here and got stopped out in this price action. But that's how you would use them for points of interest. Let's look at one more example here. Let's delete the 2 drawings. Let's look at a 1-hour example because I think those are going to be better for small time frame traders. And here's a bullish example. So price comes up, it forms a fair value gap right there. Price dips into it, and then let's mark off the last down close candle there. Oh, that might not be a valid one because I don't know if it actually touches it. Let's look here. No, it just perfectly to the tick. So now I'm gonna highlight this so we can find it on a lower time frame. So now this would be the ITOB. So it's the 1-hour fair value gap, and then here we marked up the ITOB. And then price comes down, just barely touches it. You don't have to immediately enter to catch that. But then there's another ITOB right here that price gives you. So people are having a lot of success with this. I'm glad to hear it. So I just want to show you guys how to use the ITOBs as great stop placements and places where you can move your stop up to safely. So here we are at the end of the day on ES on a 2-minute chart. Let's go forward until we see an ITOB form. So right here price is coming down. So just while we're here, I just want to really break this into you guys. So a bearish fair value gap right there, right? So I'm going to look for that to be disrespected before I enter a bullish trade. So price is consolidating and there now. So now we're having full close. We're looking for a full close above the bearish fair value gap. So there it is. So now let's flip it. Let's flip this fair value gap bullish and then look to enter here. So, or another bullish fair value gap to get dipped into. So here we go. So now you have an ITOB that is formed, right? Boom. ITOB is right there. So now you can enter here, and let's go forward a little bit. And then let's see if another one forms. There we go. So now you can safely move your stop from, because you entered here, right? So now you can put your stop loss safely here. But just give it like a tick or two. There's also a volume imbalance there. So while we're here, I want to talk about the volume imbalance. I get a lot of questions about it. So what is it? So when there is a gap between two candles, that is a volume imbalance. And a lot of times you'll see price wick past a fair value gap, and that's why, because it needs to fill it. So what happens here is the buying is so strong that when this candle is closing, price is moving up aggressively, creating a small gap. That is a volume imbalance. So because that is there, just to be safe, put your stop loss just below that and just below the ITOB. So as you can see, to the tick on that ITOB. Let's go forward. And then we had another fair value gap form right there. So then you could safely put your stop loss below here with the ITOB being there. So now we can move our stop up here, get rid of that, move our stop loss up here. Go forward. And then now we're looking for another fair value gap to be filled. Price is coming down. And then that's the market close right there. So you guys can use these to follow your stops safely up all the way up price action, because if it's going to continue up, these intermediate term lows are not going to be broken. So in the next scene, you guys will watch a trade that I'm going to break down a trade I took and how I use these concepts in it. So in this section, I break down a trade I took on NQ at 8:30 in the morning. It is my slip and rip strategy, which is another video I did that I broke that down. It's the how I passed the 50K trading strategy. So check it out, guys. Enjoy. So first thing to note here is we have equal highs. So that is also going to act as a magnet for price, right? So right here, we're just going to draw that. So you have equal highs. So you have two things that are going to draw the market towards it. So that is the draw on liquidity. So we have the equal highs and midnight opening. And then we're going to start looking at the market structure here. So which side of the market is respecting the ITOB? So we have one right here. So last down close candle, perfect touch, just as I teach in my second video. This is part 2 of it. So why is that an ITOB? Because there's a fair value gap there. And inside of the low that creates the intermediate term low is the real order block, which is right there. So as you see that, but then when we come over here, goes up, puts in a low, and then it's disrespected. So now, before I enter trade, I'm going to need to see a fair value gap be disrespected. So we have one right here. Mark that off. And let's just go ahead and fast forward a little bit and wait for one to be disrespected before you want to enter. But you see, as price is not violating this, it continues up. Now here, now we have a full close above the fair value gap. The ITH has now been broken. So that's a real break in market structure. The way that ICT teaches it, it's probably not the most accurate. That's why I stopped using it. But I found this way, if you use the intermediate term highs and lows, as market structure shifts, your entries into fair value gaps will be a lot better and a lot more. It will actually help you. Okay, so now we have a full close above it. So now I'd be going down to a smaller time frame and looking for a fair value gap entry. If one doesn't show up on the 3 minute, then I would jump down to a smaller time frame. And I'd be looking for an entry here. Let's go ahead and fast forward a little bit. So here's your entry. Let's go ahead and remove that. So see how it works? You break of the fair value gap, the bearish fair value gap, and then that's going to be your entry, and then you put your stop somewhere down here, not too close because it could wick, but you're going to want to give yourself a decent stop. You can move it up once it shows more respect of it. So there we go. Now you can move your stop there and be pretty confident that it's not going to get ran. So, and then these are your targets. So your stop is only, let's say you entered here 40, 12640. You're only initially risking 9 points on NQ, which isn't very much, and then you're going to be targeting up here, which is 40 points. So that's a 4-hour trade, which is really, really good. And this is how I trade my funded accounts. In these next couple of videos, I'm going to be going over funding strategies using ICT smart money concepts with my own spin on them, help you guys get your accounts funded. And then here we go. So at this point in a funded account, you're going to want to be taking profits into here because you're up 30 points. 30 times 20, that's a lot of money. And then let's go and fast forward a little bit more. And then there's another fair value gap where you could have re-entered. So something I do a lot is I will enter once, I will scale out one contract, and then I'll look to add it back. So I would have added back here, and then I move my full stop up to here, just below here, because this filled in balance. So this is these are both intermediate term lows. Like that, right? So let's zoom out and see what we're looking at here. Is this high filling a fair value gap? No, I don't see it filling one, but it could be on a higher time frame. So it's something you need to look at and make sure that you're not running into an intermediate term high that's gonna, on a higher time frame, that's gonna act as resistance. Let's go ahead and go forward a little bit, and there you go. So there's your take profit, 4-hour trade using the strategy I teach in the other video. I will put it at the end of this video, so you guys, if you haven't watched that video yet, you can. It's using this morning swing up, moving towards the midnight opening. So let's go forward a little bit and then see it immediately dump. So immediately dumps, violating the ITH. And then so this price action right here is a purge and revert. So it came up, cleared out the liquidity, and then so now the liquidity pool's been purged, the buy stops have been ran. Because if you're a seller, you put buy stops, so it's buy side liquidity pools above here. So now that this has been violated, delete the bullish fair value gap, and then you'd be looking to go short. So let's go and go forward a couple bit, and then so now you have this bearish fair value gap that has formed, and it's about the New York opening. So you'd want to be looking to go short here and seeing how it reacts to this order block right here. If you get a bullish reaction here, then you'd be looking to exit, but you put your stop here, and then it's most likely continue dumping because we already broke one. So what's standing in the way of this one? Nothing. So there you go, it gets broken. So you see how in a funded account you can just rack these scalps up, especially the futures, and then real quickly you can get funded. 3,000 profit target isn't anything when you're making 1,000 a trade or so.